Welcome to today's webinar, and thank you very much for attending this review of the first half of the year. We do this every quarter. We try to see what has happened and what this means going forward, which is more important. I'm Michalis Florentiades. I'm the Chief Economist here at XM.com. I'm the Head of Investment Research. So let's delve right into the presentation and to start talking what's happened. First of all, I'm going to give you a rough outline of what we will talk about. We will talk about what happened in the FX markets and in the major assets year to date. Who were the winners? Who were the losers? What is the information we wish we had 6 months ago to have made a very good profit and avoided losses. And then we will look at the US and the Fed, what is happening there. Of course, the world's second largest economy is the Eurozone, what's happening with the Euro and the ECB. Then on to Japan and the Bank of Japan, and then UK, of course, the issue of Brexit and the Bank of England, what this means, and we will talk a little bit about that. And then we will talk about Australia and China, two important economies. The Australian dollar, a very important currency for a lot of you. Some economic forecasts in light of the recent developments, what has happened. We will talk about crude oil and gold. I know some of you trade commodities, so you want to, you are very keen on listening about gold in particular, not only about the currencies. And we will have the summary, what it means for going forward, and favorite trades. So hope you will find it interesting. So maybe the most interesting part for you will be last as a trick to hold you here. If you have any questions during the presentation, please post them. You can key them in, but I will keep in mind that I will probably be answering them after the end of the presentation. So I might not be answering questions during the presentation. So without any delay, what happened during the first half of this year? Who were the winners and losers in the foreign exchange? Obviously, yen has been the strongest performer overall out of all the majors. We will have a look at the yen chart and the yen performance. It was pretty amazing. The pound, on the other hand, has been on the receiving end of much of the selling, and of course a lot of that selling happened after June 23 and the morning of June 24th, when it looked like UK, the Leave side was winning the UK referendum on EU membership. For example, this gave also the euro versus the pound was the best performer, and actually pound yen rate was more like an emerging market cross. Why do I say this? The losses we saw on pound yen were really something you don't see very often in foreign exchange markets. Among major currencies, that is. Among emerging currencies, it happens, but among major currencies, that was a really big move. Now, the Aussie, the Australian dollar, and the loonie, the Canadian dollar, also did well as commodities had a bright first half. We had a very big scare during the first month and a half of 2016, but then we had the rebound in oil, and commodities did well generally. So when commodities are doing well, Australian, Canadian, and New Zealand dollars also are doing well. Now, the euro held. That was also a bit surprising. The euro did well despite massive ECB stimulus, and it managed to edge out the US dollar. So it actually had a positive performance versus the US dollar. So what would have worked in retrospect? If you were short the pound, obviously, if you were short, not aggressively, but a little short the US dollar, if you were long the Japanese yen and the commodity dollars, these were the winning trades. But this was not an easy quarter. It was very, very volatile. I mean, the volatility we saw at the beginning of the year was quite something, and then we had Brexit towards the end of the first half that really shook things up as well. So, and it boosted the US dollar. So this is a chart that we are looking at, and you see what happened roughly. On the top is euro versus pound, the euro gaining 16.5% versus the pound. Maybe that was a little surprising given that the euro was also seen as vulnerable to Brexit, but in the end it was a very positive performance because the euro held up well. Even against the dollar it managed to post a small gain. Further on you would see the loonie, the Canadian dollar, rising by 6.4% versus the US dollar. That's a significant move. The pound versus dollar, a very, very popular cross these days, very volatile as well, fell by 12.3%. But you see the yen, how much it gained versus the euro, almost 14%, versus the dollar, almost 16%, and versus the pound, a whopping 26%. So this is just to show you what's happened and who was the winner. So yen winner, pound loser is the short version of what we showed. Now, in terms of the asset performance, the big surprise was that silver's major rise. It gained over 40%. I think 20% of that gain came after Brexit, but that was definitely a huge move. This was followed by oil and gold. They put in very big gains as well, 28%. Of course, one might say that oil was very volatile. It was coming down from $110. It fell all the way to $28 and it rebounded to around 50. So that's the bigger picture. Oil is still down a lot, and gold is still down a lot. If you remember that gold had a 1900 all-time high a few years back. And the CRB commodity index was also positive. I mentioned this because oil and gold and silver are kind of special. Oil has its own factors. Of course, each commodity has its own factors, but when you're talking about the CRB index, oil, of course, is in there, but also you have metals and you have agriculture. So overall, commodities have been under pressure, but during the first half they did well. After this, one of the best performing assets were long-term safe bonds. So German bonds, US treasuries, UK gilts, these are the government bonds of these countries. They did very well, mainly on central bank actions. We had a generally low inflation environment, and we had deepening negative rates. We had negative rates in Japan, even more negative rates here in Europe, and this certainly helped bond markets. And QE, quantitative easing, the expansion we had in Europe, in the Eurozone. Now, stocks ended the quarter ended the first half with small gains. Again, what was surprising is another, let's say, dark horse was emerging market equities. Well, this is an asset class that a lot of people avoided, but they actually outperformed developed equities. A lot of fears about emerging markets, especially if the Fed was going to tighten. But guess what? The Fed didn't tighten, and emerging markets did quite well. And we don't know when the Fed is going to tighten. It doesn't look like they're going to tighten very soon. We'll talk about all that shortly. And the worst performing stock market was the Nikkei because of the strong yen. So strong yen certainly helping hurting the Japanese stock market. So this is what we are talking about. You see silver's gains, 45.5%. Then you see oil and gold from 28 to 30%. Then you see the safe government bonds, which is UK 10-year, US 10-year, German 10-year. They are also doing very well. So it's noteworthy that the FTSE 100 had a positive first half, around 3.5%, but that's more to do with the fact that the FTSE 100 reflects a lot of international companies, so it's not exactly reflective of the UK economy. The S&P 500 also had a positive first half, and emerging equities. So that was interesting. Copper, despite commodities doing well, didn't do so well, and copper is very sensitive to economic fluctuations, so maybe something that is showing that things are not going so well with markets, with the economies, and I mean demand for copper. Now, on to the world's biggest economy, the United States. What are the fundamentals? It's forecast to grow by around 2.2% in 2016. Let's see if Brexit impact is going to cut growth in the second half of the year. Maybe, maybe not, we'll see. People in the US are quite optimistic that the Brexit woes are not going to hurt them particularly. Now, we had the economic growth in the first quarter slowing to 1.1%. This was also revised upwards because it was initially reported much lower. This was down from 1.4% in Q4 of the last quarter of 2015. And second quarter growth is expected to pick up to 2.3%, even higher I would say, even 2.5 to 3%. Core inflation is around 2.2% in May, and the headline rate about 1%. So excluding food and energy, we have much higher inflation rather than the headline rate, because energy, might be up, oil might be up during the first half of the year, but if we compare it with a year ago, it's still down, and it's exerting a downward pressure on inflation. Now, US inflation has eased again after peaking at 1.3% in January. We are waiting for an inflation pickup towards the end of the year. And the unemployment rate is very low at 4.7%, very, very low unemployment rate. But is this really due to many people working in the United States, or is it to do with fewer people searching for jobs and discouraged workers and fewer workers actually available for work? Because that can play a big role in reducing unemployment. So you have this debate whether in the US the labor market is as strong as this 4.7% rate implies. Now here, something that I would like to watch. This is the growth for the first quarter. It's obviously relatively low. But what happened last year? Last year, growth was very low in the first quarter, but then you see it jumped all the way up to like the 3.9%. What happened in 2014? Growth was negative during the first quarter, but then in the second quarter it jumped all the way up to around almost 4.5%. So is this going to happen this year as well? We're expecting a jump around here. So just keep in mind that the first quarter growth was not so great, but first quarter growth last year was not so great. First quarter growth 2 years ago was not so great. So maybe something to do with the seasonal patterns. We don't know, we'll have to see, but definitely expecting growth to pick up. And this is inflation. Headline inflation has come up, but it's around 1%. It's not very high. I'm sure all of you tomorrow will be watching the non-farm payrolls. So we have non-farm payrolls for the past 6 years just to show what happened because it's very topical and very interesting. Last month we had the 38,000 non-farm payrolls, which was a huge negative surprise. The other data, though, we're expecting this to pick up a little, pick up quite a lot actually, to 180,000 if you believe the Reuters poll. So we're expecting it to come up and maybe this to be revised higher. But you see, I think there is some deceleration in US job growth in the past few months. If you check previous, like 2014 and 2015, we were averaging around 200,000, and even we had as high almost as high as 300,000. So I think the pace of job creation in the US is slowing. This is not necessarily such depressing news. It could be that there is a skills mismatch. That is, employers are looking for workers, but they cannot find the workers with the right skills that they are seeking. So this is the reason why we could get slower job creation. It doesn't mean that the job market in the US is a disaster or that people are searching for work and they can't find any. So just keep this in mind when you're getting about the non-farm payrolls, especially tomorrow. Now, very quickly about the Federal Reserve. The Fed has kept rates at 0.38%, medium, like from a quarter to a half a percent. This is our target. Now, in June, the Fed still expected to raise rates 2 times in 2016, so 2 quarter point hikes. What happened since then? Well, actually, this business with Brexit has led to a lot of speculation that the Fed is going to be very careful about raising rates in 2016. If some are even pushing it next year, they're not even sure whether there's going to be a rate hike next year. So it's not looking very likely. And the Fed, when there is market turbulence, and Brexit has caused quite a bit of market turbulence, the Fed is very cautious. It doesn't want to add to the problems facing the market. It wants financial conditions to be good, and it's not going to risk coming out strongly in favor of a rate hike, particularly when there are things in the market, when there is volatility in the market and there is concern. So it supports the economy in this way. Now, we also had the very weak non-farm payrolls, the non-farm payrolls for May, which were announced at the beginning of June. So if we have slower job creation plus Brexit, the Fed governors that have spoken in the past few days they have said that inflation is also relatively low. So not much prospect of a rate hike, and we have the U.S. elections ahead, and the Fed is probably reluctant to play around with interest rates ahead of a U.S. election. It can be seen that it's getting political, so maybe it will stay. The first opportunity it will get probably now is December. But even then, market is not sure that there's going to be a rate hike. So we're waiting. Inflation is low, but I wouldn't say it's so low. The core PCE, this is the Fed's favorite inflation index, is about 1.6%. The core inflation, as we saw from the previous slide, is around 2.2%. So I think that the Fed is running very loose policy for where inflation is right now, but they see that there's not a huge inflation trend. They can run with this. They can keep this low interest rate for a while. Here I put you the dollar index, which is the index of 6 major currencies versus the dollar. The euro, however, is like overweight in this dollar index. I think more than half of this index is by the euro. So you saw that the dollar, last December we had the first rate hike by the Federal Reserve. A couple of weeks before that rate hike, the dollar index reached almost the 100 level. But then we got kind of a dovish Fed, so they were not ready to hike rates, because you remember at the beginning of the year we had some turbulence in the market, so the Fed grew quite cautious, and in March the March statement was also relatively dovish, so this led to a sell-off of the dollar index to around the 92 level. Since then, we got some better data in May. Some Fed speakers said that they were going to raise rates, maybe expectations of raising rates in June and July, but then we get the non-farm payrolls, the massive disappointment of that 38,000, and the dollar drops again. So what comes to the rescue of the dollar? Brexit. You see this spike up. This is Brexit happening, and dollar immediately became a safe haven, and it rallied very strongly on the back of, so back to the 96 level. So it's above the 200-day moving average, and it's fighting to get above the 50-day moving average. On to the Eurozone. Growth in the Eurozone is doing better, but nothing to get too much excited about. 0.6% in Q1. It is the fastest in a year. We're expecting slower growth in Q3, and annual growth around 1.6%. For the Eurozone, that's not bad, mind you. That is not about 1.5 and 2, between 1.5 and 2% is not bad, but we have to see what this turbulence with Brexit might bring. Inflation, it seems that the Eurozone has dodged the deflation bullet, which means that deflation is negative inflation. So right now, inflation was at 0.1%. It's barely positive, you can say, but for the year, it's expected to be around 0.3%. Eurozone unemployment has also fell a little bit. It's high, I mean over 10%, but you have to say that there is some progress happening in the Eurozone. It was 10.4% at the end of 2015, and now it's 10.1%. The confidence indicators, business confidence indicators, PMIs are showing that the Eurozone is doing well. So it is gaining momentum, but the problem with the Eurozone, there are no structural reforms. I should say no structural reform, but slow pace of structural reforms. We have the Brexit shock. It's going to take out 0.5%, according to Mario Draghi, the ECB president, for the next 3 years. And we also, there's always an election or referendum in the Eurozone that we should worry about. We had the Spanish elections on the 26th of June. They went quite well in the terms that, let's say, the Podemos party didn't win. The market is, let's say, more afraid of the far left, forces right now. So we have that to worry about, the anti-EU forces, let's say. We have, of course, the Five-Star Movement in Italy. We had the municipal elections. The Five-Star Movement did quite well. We have a referendum on some reforms by Prime Minister Renzi in Italy in November. Next year we're going to get French elections with Le Pen. So as always, Le Pen being an anti-EU and anti-Euro candidate, let's say. So there is some fears about political instability in the EU, and maybe if there is a rising anti-EU sentiment. So we see here The pink is the headline inflation. The core inflation is running at around between 0.8 and 1%, if you see here. So core inflation is still pretty low. You would want core inflation ideally to be around 1.5 to 2%, where it is in the US. So it is a bit low, but it is showing that core inflation, which is more weighted domestically and maybe has more services, is above the core inflation, which is depressed particularly by energy and cheaper oil. And you see GDP growth relatively stable in the Eurozone. Now, what is happening in the ECB? I'm sure you know the big stimulus measures that the ECB has undertaken. It's now buying corporate bonds. It has launched the corporate bond purchase program in June. It has the targeted long-term refinancing operations, TLTROs, and it has a negative deposit rate of minus 0.4%, and it can only buy bonds which yield more than minus 0.4%. And this is becoming an issue actually, because so many bonds in the Eurozone are getting a negative yield. Now, there was an upgrade of the growth and inflation forecast, but now with Brexit in the latest meeting in June, but now with Brexit probably they will have to downgrade those prospects again. We have the vulnerability of Eurozone banks, particularly in periphery countries such as Italy, although some can say a bank like Deutsche Bank is also not in the strongest shape. So, but Italian banks have some of the highest non-performing loan ratios in the Eurozone, after the non-performing loan ratios in my home country of Cyprus. And political instability could also upset the ECB forecast. So we have this far right, far left parties that are making the anti-establishment parties. And it will be very interesting what the ECB does next. What's the ECB going to do next? Because will it have to buy bank bonds? If it buys bank bonds, that's like providing banks with capital and liquidity. So, I mean, it may sound a good idea, but it's not the central bank's job to boost the financial sector so directly. I mean, it would raise quite a lot of issues if they do that. They could loosen the requirement for government bonds, so they could buy more bonds from Spain and Italy, let's say, whose interest rates are higher than Germany. Germany has most of the interest rates up to 10 years is now in negative territory, so it's very limited. Although Germany is the largest shareholder of the ECB, and the ECB has to buy bonds according to at the ratio of shareholdings of each country. So the largest shareholder is Germany, is supposed to buy 33% or something of German bonds. But we see that German bonds up to 5-6 years are all yielding less than the deposit rate of minus 0.4%, so they cannot be bought. So does it make sense for the ECB to buy 10-year German government bonds? They are now at minus 0.2%, to take them also to minus 0.4%. So this is the questions that the ECB has to address soon. At the same time, we have other people buying safe government bonds, such as Germany's, and because of the Brexit event, this has led to higher demand for safe havens. So there is speculation what the ECB is going to do. So far, it has denied that it's going to do any of these thoughts that I mentioned here, but these negative yields, they remain an issue, and they are constraining what the ECB can do. This is the the chart of the euro versus the US dollar. And what has been a little surprising for me personally is that the euro has managed to hold the 110 level relatively comfortably in the, let's say, the past 3.5 months, almost 4 months. So it hasn't really been put under pressure. Whereas if you see the range for euro dollar, it has been from 105 to 115. But the euro has stayed in the 110 to 115 range, and even Brexit here, so when Brexit took place, it just dipped below 110, but then it came back. So the euro has been very resilient, like particularly given the monetary stimulus that the ECB has pumped. On to Japan. Japan had a good first quarter, 0.5%, but we are expecting slower growth in the quarters ahead. Core inflation is in negative territory, is in deflation. Inflation is non-existent in Japan. A strong yen is also depressing inflation. Unemployment, one very good indicator in Japan is unemployment. It's very, very low at 3.2%. It's one of the lowest unemployment rates in the world, but we don't have wage pressures. So no rising wages. That means that consumption is not accelerating. That means that without consumption, getting economic growth is very difficult. The exporters are getting hurt by the stronger yen. So if exports are not helping, consumption is not helping, where are you going to find growth? So there is increasingly the question if Abenomics is working. And quite clearly it is not, because we are seeing the stock market going down, we are seeing the yen going up. One note about the yen here, someone could tell me, I mean, Japan has so many problems, like deep structural problems. Why is the yen doing so well then? So this is an important question for the market, and this is not so easy to answer actually, because the common answer is that the yen is a safe haven, and in times of turbulence, people buy safe haven currencies, and because Japan is a net creditor, so it lends money to the world, instead of borrowing money, it's a relatively safe destination. That's an interesting, but you saw the first half performance, it was not like end of the world kind of performance. So we are seeing also the yen becoming stronger even on days that the stock market is advancing. So that's an interesting phenomenon. I think that is, I would characterize one of the mysteries of the foreign exchange market of the first half. Like on the one hand, Japan weakening quite a bit, the fundamentals, but the yen being so strong. So this is the GDP. You see that the GDP growth in Japan is not getting much traction. We see some negative quarters also. So, and we have also the drop into inflation. This hump over here for the inflation has more to do with the rise in the sales tax in 2014, which did cause a serious drop in the GDP. Like we said just a minute ago, the yen's appreciation is hurting the Bank of Japan's chances of hitting the 2% inflation target. It looks quite far away, that target, actually, and we keep getting a delay of when this target is going to be hit. Now, maybe the Bank of Japan is going to act in July. Maybe they will put some extra quantitative easing. I don't know whether they're going to cut interest rates more into negative territory. That's a big question and remains to be seen, because negative interest rates were not very popular in Japan. There was strong criticism, we'll see whether the Bank of Japan attempts to have even more negative interest rates. And this strong yen, the Bank of Japan really has to do something to fight it. So more QE is one idea. We haven't seen Japan directly intervening in currency markets. Well, I think they intervened on the morning of the Brexit announcement, but that was not made public. So it's just my own speculation. I'm not saying that this happened. Don't have proof that it happened, but the price action suggests that somebody did intervene. So maybe they will be forced to intervene again, and particularly as we see, we are going to see, I think, a huge battle for the 100 yen level in dollar yen. So that is going to be, I think the Bank of Japan absolutely wants to keep dollar yen above 100, because if it doesn't manage to stop dollar yen at 100, we don't know where it will stop. So we might see some intervention around there, because I think the Japanese are very, very worried about what is happening with the yen. On to the UK, which has provided much excitement. Okay, growth slowed down, but it's very critical to see what is happening, of course, post-Brexit. Will we see a recession, or will we see just slower growth? So if the UK economy came into Brexit running at a 2%, let's say, growth rate, then it probably is just going to have slow growth. However, if there was a slowdown before Brexit took place, then we will probably get a recession. So this is a critical question right now regarding the UK. So we'll have to see what is going to be the impact on the UK economy, whether some firms are going to relocate or not, or like questions like access to single market, financial services passports. So this is the unemployment rate. The unemployment rate quite low in the UK, around 5%, and decent growth, but let's see what happens after Brexit. Now, the Bank of England was there after Brexit, was ready to take action, and most analysts are now expecting a 25 quarter of a point reduction in UK rates in August from the present 0.5% to 0.25. That would be a record low, mind you. The Bank of England only cut as far as 0.5% during the crisis. Also, some are speculating on a restart of the QE program. The Bank of England has lowered the capital requirements for UK banks, the counter-cyclical buffer that it asked for banks to have. So this is to encourage lending. And the Bank of England does have some dry powder because it said it has not intervened so far. Well, with respect to the pound, Carney seemed to welcome the pound's slide and has said depreciation was helpful for the economy. So I don't know whether this is something that could encourage pound shorts. So this is cable. You see it was roughly between 140 and 150 up to Brexit, and now we are around 130. Similarly with the euro pound, 80 to 81 was like the high, and now we have crossed to 85 cents, which is about 3.5 year high, I think, for the euro versus the pound. So what should we watch regarding Brexit? First of all, who will be the next Prime Minister? David Cameron is leaving. UK needs a new Prime Minister. Who is it going to be? What are their policies? So what are their positions? That's the first thing that needs to be clear. Secondly, what will the deal between the EU and the UK look like? Specifically, what's going to happen to trade between the two entities, to services, the financial sector, and immigration? Now, these are all open questions. What will happen to Scotland and Northern Ireland? Although this is not so urgently on the table, I think that the Scottish are not moving as fast as was the impression of the first few days. Also in Northern Ireland, I mean, it's an issue, but they are not pushing so hard right now for something, these two regions. And of course, will other EU or Eurozone countries use Brexit as an inspiration? Will there be other referendums? Will there be other EU exits? So there is this contagion risk, of course, that is another very big source of uncertainty. Far away from Europe now to distant Australia, and we have a good economy there, GDP expanding at a very strong rate in the first quarter, 1.1%. There was a rebound in iron ore prices. You remember we said that commodities are doing a bit better. And the economy is going to do quite well in actually in 2016, rise to and grow by 2.6%. Inflation fell back a little during the first quarter, so we see this prompted the surprise rate cut by the Reserve Bank of Australia. We'll see whether the Reserve Bank of Australia is going to cut rates again. It had a statement the other day. It kept rates unchanged, but if there is going to be a move, it's more probable it's going to be down rather than up, but they're not in a hurry to cut. That's what my reading was anyway. Unemployment is also good. It was above 6%. Now it's at 5.7%, holding relatively well. And what should Australians be worried about? China. A very big slowdown in China is going to affect Australia, of course. Brexit is a downside risk, although the Reserve Bank of Australia said that Brexit is mostly going to hurt the UK, not Australia. They don't see the global economy suffering because of Brexit. So that's an interesting take, given all the, let's say, fear-mongering that Brexit is going to be, have very dire consequences for the world. The RBA was quite calm about Brexit, actually. What we do have, another issue that we have in Australia is some political uncertainty after elections. This is debatable because you have one rating agency, Moody's, saying this is a short-term uncertainty. We don't see it impacting Australia that much in the long run. But on the other hand, you have Standard & Poor's downgrading the outlook from stable to negative, saying it could hurt chances of fiscal consolidation and policy after this a weak government that is going to emerge from this hung parliament. The Aussie has retreated from the highs of above 78 cents to around 74.75, and we have some expectations of further rate cuts by the RBA, so that might keep downside pressure on the currency. And also the RBA does not like a strong Aussie. So if we get a strong Aussie, they are more likely to cut rates. So that might dissuade people from pushing the Aussie too high. This is growth and inflation in Australia and the cash rate, what has been happening. And this is the chart of the Aussie. It's looking positive right now. It's trading above the 50-day and the 200-day moving average. So it will be interesting. The technical picture is not so bad for the Aussie, but I think there are some downside risks fundamentally. On to China. We had a slower first quarter, and it's expected to grow by 6.5% in 2016. That's quite a a deceleration from the previous years of growth rate. We have exports and manufacturing struggling. Manufacturing output is having problems. It's no longer contracting according to official data, but it's facing challenges. Weak inflation. The yuan is kind of falling. It's just off 6.70 versus the US dollar. It's at 5.5-year lows right now. However, we are not seeing the yuan panic and worry that we saw in the beginning of the year. So analysts are expecting some stimulus in the second half of 2016, even more stimulus in China, but we do have concern because we have very high corporate and local government debt. So we have this debate whether China is a really healthy economy or whether it's one that has been built by debt, like has been boosted by debt. It kind of escaped the consequences of the 2008 financial crisis by pumping a lot of debt into the economy. But when is the time of reckoning going to come and may be hurt? So services, this is the services PMI for China. It's decelerating, but it's holding on to relatively healthy levels. For manufacturing, it's much closer to 50. So this manufacturing is suffering a little bit, not as good export growth, and it must be said that global trade, there are some worries whether China's exports are holding up because of the global picture is not so very good. This is just Citi was one of the banks that updated their forecasts in after Brexit. So it sees the US fairly negative forecast, by the way, at around 1.8%, next year 2%. Euro area 1.5%, next year slowing to 1.1%. The UK 1.3% this year, but falling to less than 1% last year. That's not such a bad forecast for the UK. So industrial countries at 1.5% and emerging markets a big improvement next year. So this should be interesting. Crude oil next. Oil prices have rebounded. Why? Because non-OPEC output seems to have fallen. Non-OPEC and non-Russia output, I would say. The commodity, we said, is one of the best performers this year. It's up 28 to 30%. Although some might argue that this looks like a dead cat bounce, but it's as we have to give it that it's one of the best performers this year. We did have supply disruptions in Nigeria. We had the rebels there attacking pipelines. Libya, Venezuela is facing a lot of problems. Canada, we had the Canadian wildfires shutting down some oil sands oil production, and declining output from the US as some high-cost shale oil has been production has been stopped. And these have offset the higher production from Iran. So it's looking a bit more balanced, the crude oil market, and this has allowed the price to rebound. But Brexit has added some uncertainty, and it has dampened there is a bit of uncertainty now with Brexit whether global growth is going to be hurt. And Reuters survey is saying around $45 a barrel and $44 a barrel for WTI. So not very far from the current levels, maybe a bit lower. They're not seeing oil gaining as much. This is the oil chart, the lows that we had, like a double bottom there in January, February 2016, but then an almost doubling of prices up to the... Gold is up almost 28% onto the precious metals. Safe haven flows, low interest rates, monetary stimulus wherever you look, low, I would say even negative interest rates. So this is also something that is helping gold. And uncertainty. I mean, you can say what happened with Brexit. It was a huge boost to gold. It was like I think 60, 70 dollar move overnight for gold. So after Brexit, the Fed is not going to raise rates. Bank of England is going to cut rates. ECB and Bank of Japan probably even more stimulus. Silver prices have also benefited from the increased risk aversion. Prices have rallied 43%. With silver, it's a bit more tricky because silver is also an industrial metal, but I think it was a very low gold to silver, very high gold to silver ratio that the relative value, maybe a lot of some investors saw relative value in silver and drove it up. But we'll see what happens from here because this ratio, the imbalance in that ratio has been restored a bit, and silver needs industrial demand to move higher. And you see with silver how much it has jumped following Brexit. These are the very big gains that we talked about just now, that we had silver jumping, almost a 20% jump. Summary, what you should know going forward. I think the winners and the losers in the currency market will greatly depend on risk appetite. What do I mean by that? I mean that a currency like the Australian dollar, for example, is going to do well if there is positive risk appetite. This same goes for the UK pound. If there is negative risk appetite, and we see a lot of nervousness, very big volatility in stock markets, it traditionally has helped the yen and the Swiss franc. The dollar and the euro is not so clear what they're going to do. The euro is probably going to lose out on risk appetite, like on negative risk appetite. The dollar is not so clear because if there is volatility, that would make the Federal Reserve even more likely to not to raise rates. So it's a bit more confused. Now, the post-Brexit environment is looking more volatile. Why? I think that markets will be much more sensitive to political uncertainty. Like we have the Italian referendum, US elections. Hungary has also called for a referendum on UK immigration. France next year with the presidential elections. Le Pen might have a strong showing there. And we still don't know who is going to be in charge in the UK. So the US dollar is going to keep its reserve status. It's the reserve currency of the world. But the dovish Fed is not helping bulls. The Fed has proved again and again and again, I think, dovish. So this is not helping dollar bulls make any profits out of the US dollar. It's a reserve currency, okay, but there are limits. The other majors are ranked in the following order. We would say that probably the yen is more popular now with investors, followed by the euro, followed of course by the pound. The pound, we will talk about that in a second. So the pound should suffer because Brexit brought on a lot of uncertainty, and it's not clear to me how that uncertainty is going to lift anytime soon. The Aussie, on the other hand, is doing relatively okay. The Australian economy is growing well. There are downside risks for the Aussie too. There is the rate cuts, if we have more rate cuts. Maybe we have Chinese developments. Maybe commodities stop going up as quickly. And maybe the Reserve Bank of Australia, watching the Australian dollar, if it sees it going up, it may cut rates. The euro, from its part, has had a very good first half, given all the ECB measures announced. But, you know, it will have an impact from Brexit. We had the news about the Italian banks recently very much in the news, a lot of political uncertainty. The euro is resilient, but it does have these issues and we should recognize them. Now the yen was the best performer despite all the problems Japan is facing: slow growth, stronger yen, lack of reforms. It's a safe haven story, but the yen is holding its gains even as we have risk rallies, and the recent Brexit example was one to remember. Now for commodities, they were a strong performer during first half. Was that the debt can't bounce from very low levels or sign that global growth will be okay? So watching gold, silver and oil will be very key. And I would point out that oil and gold need not move in the same direction, by the way. So this is interesting to watch. Gold and silver for nervousness and oil for risk sentiment, confidence in the global economy and stocks. So this is very key. Now some trades. Let's see what we said. We said that playing the range in euro versus USD. This is what we said back in the beginning of April, and since we want to be a little realistic, we have to check if we had any good ideas or not. Now, we said that it's a good idea to play the range of between 105 and 115 for euro USD, and actually the range was more 110 to 115. So it didn't let you buy the euro at low, much below 110. Short the Aussie dollar was a good trade. We had that it was going to have a top at 77 cents as a maximum. It reached 78.25 actually, and then it fell to 71 cents. So that was more or less. So moving forward, the pound should be volatile, but overall its bias will probably be on the downside. Buying euro pound or selling USD GBP USD could be profitable but risky. So buying the euro against pound or selling the pound versus the dollar could be profitable, but it's a very, very risky trade and only for the brave, because we are seeing some 200, 300 pip moves in a single session from the pound now, so it's only for the brave. On the other hand, gold, it should do well in times of economic weakness. Rates are very, very low. We have rates going negative and down, down, down. Possible risk aversion. It's a good hedge. So gold is still in a long-term decline from the $1,900 level, but the medium term is more positive right now, and it has a more positive outlook. So that's all from me. I hope I didn't tire you or you found this interesting. If you have any questions or comments, please feel free. Now is the time, and you can also visit our homepage in XM. You can go to our Facebook page, follow us on Twitter, go to our YouTube channel, Google Plus and Instagram. Thank you very much for your attention, and I'm waiting for your questions. Now, there is a question on France and the possibility of it leaving the European Union. There has been speculation that France is going to leave the European Union, or Italy is going to leave the European Union. Personally, I don't want to be dismissive of such fears, because obviously there is strong political risk if we have a leader like Le Pen winning the election next year. I would think that it's certainly more risky what is going to happen with the Euro and the EU project, because France is one of the founding members, and it will be something very significant. But for countries like France and Italy, I am not as, or the Netherlands, because we are talking about Nexit as well, or Netherlands exit, let's say, or net exit, I don't know what is the other. These countries, I don't see them being as Eurosceptic as the British. I think the British were and are in a league of their own in terms of Euroscepticism. I'm not saying that the EU is, hugely popular in these countries, but I think that it's much more accepted. There is not that much anger directed towards the EU and its institutions as was seen in the UK, even before the Brexit referendum. I mean, there were a lot of people that felt very strongly about the EU and had very negative feelings. And I don't see that this is the case in especially the founding members of Netherlands, France, and Italy. Because if you remember, the founding members of the EU, the Benelux countries, Belgium, Netherlands, Luxembourg, Germany, Italy, France. So there's a coal and steel community. So this is, so I don't know whether it answers your question. Of course, we should watch, and I think that if this is one takeaway that you should take with you, is be very careful with political uncertainty and don't be dismissive, because a lot of people said, oh, this Brexit referendum, I'm sure they're going to vote to stay in. I'm not going to say that I predicted it. I also said that the main scenario was for the UK to remain in the EU, but I also said that there was a very big risk that it will not. So you should be aware of the political risk and how it might move markets. In terms of major currencies that will be affected in such an event, well, if we get more EU stress within the EU, obviously the euro is going to suffer, for sure. There will be, and the countries around Europe are going to suffer. I don't know whether, a country like Switzerland is going to be unaffected by euro. Also, I would go to the US as a safe haven from European problems, maybe to Japan, but we said that Japanese yen, because the market is doing it, etc. Now, the safest pairs to be traded in the next quarter, one pair that is not very volatile within this volatility, it has remained very low, was euro versus the Swiss franc. Okay, it's not by fortune, of course, that it wasn't volatile. The Swiss National Bank intervened and sold francs when it started to become a bit strong. And many of you will remember what happened last year in January with the franc shock when they released the floor of 120. So I'm not saying that it's, but from what I see, the volatility that I've been seeing the past few days, this is not as much, hasn't been as volatile. Let me see something. So overall, also I would say again, like in terms of the precious metals trade, if global growth improves and interest rates look like they will be going up, you have to be careful on that front, and you have to know that currency like gold is going to, a precious metal like gold is going, some are referring it to as a currency. And keep in mind also the other thing that I would like to stress is that keep in mind that if you're holding the dollar and you're expecting the dollar to do well, be a little careful the timing that you make, because the Federal Reserve, if the world is doing badly and if there is stress in financial markets, then the Federal Reserve becomes very dovish. So don't expect a lot of help from the Federal Reserve if you are long the dollar. I mean, yes, it is kind of a safe haven, the US economy. It is a world's reserve currency, but I don't know whether, I think they're also getting a little nervous in terms of the dollar getting a bit too strong. So with that, I think I will bid you goodbye. Thank you very, very much for all your attention and your attendance today. I hope it was useful and something interesting, then that will help your understanding of what is happening. So thank you very, very much, and bye-bye, and hope to see you in the next quarterly update if you're available. Thank you very much. Bye-bye.